Good evening. We are back for another financial strategy session and dealing with the cat witching hour at my house. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective channel, where I help you make your dreams a reality. Our stock market investment strategy, talking more about closed-end funds, represents just one way how we're going to accomplish our dreams. If you want the full methodology, those 12 steps, head over to Navigate Your Finances on Facebook, where I give the entire framework away for free. Our closed-end fund portfolio. So it's built on lasting dividends, which is very different from the current market. Current market is crazy right now, whether it's crazy bad or crazy good, our dividends pay. So the current market doesn't really matter unless you're cashing out your portfolio. The current methodology, or at least the methodology that most stockbrokers or financial planners or financial advisors, which I am not a financial advisor, but with most of those people organize a portfolio, is on this 4% method. And we're not going to get into that. That's just the gradual 4% sell off of your portfolio. And if you're attempting to hit just basic retirement draw of 40 grand right now, that's getting into your portfolio considerably more than what you would have seen, gosh, 9 months ago. So ours is different. We started a no withdrawal portfolio, in that we're going to buy and sell as needed. And I'm going to get into part of that today. But the goal is to not actually withdraw the money in the sense of selling off the consistent funds. Like, we would reinvest the dividends and withdraw them at some point as supplemental retirement or full retirement. It's not built for quick, fast gains. It's not like buy it today and sell it 2 days from now. It's also not built completely on a buy and hold strategy. That we have some funds that are marked for indefinite. We have other funds that are marked for sell price. We target dividends, and not the traditional 2% dividends or 0.5% dividend if you're shopping Apple. Talking 9% plus dividends, which allows us to keep that principal money invested and earning the dividends. So it also gives us the ability to either reinvest those dividends or at some point cash out the dividends. But the principal money itself would stay invested. So how do we do this? We're going to get into that. So up front, this is an unedited video. I mean, who knows what you'll hear in the background as I film these in my house. The disclaimers: I am not a financial advisor. I am a financial strategist. I'm going to get into a little bit of our strategy in addition to the closed-end fund system, just of what I'm thinking about in regards to our own portfolio. I don't speak like the herd. I'm going to be transparent and as honest as I can be. I walk in limited company. Sometimes I walk alone, and I'm okay with that. Meaning, gosh, I get frequent financial strategy emails from some people I trust, and from some people just because I want a different perspective than what I normally get, a challenging perspective. And some of what I'm going to give you as options tonight is limited company, and some of that will be walking alone. Overall mindset, things that help guide our strategy. The longer we've been in it, the better we do. The more knowledge we have, the more strategy we understand, the more we understand our limits, the more we understand our boundaries, the better we're able to sift through all the other advice. So regardless of current pricing, the market looks forward. Regardless of how much you know, there's risk. You increase your knowledge, you limit your risk, or you decrease your risk, however you want to say that. The more you learn the more you learn and project the market, the better you'll do in the long run. The more you understand that many of these financial firms, and even the people I like the best, hinge on everything the Fed says and take what the Fed says as absolute truth. And the more you understand how that game is played and understand how your strategy fits into the system, the better off you are. Now, do I hinge on everything the Fed says? No. Their goal is to combat inflation and beat it down to 2%. And they say they're winning the war, but Inflation rose last month. So are they winning the war? No. Could you argue it's better than what it used to be? You could if you trust what the Fed is saying. Now, if you don't trust what the Fed is saying, I would disagree with the Fed. But if you believe what the Fed is saying, then you could make the argument that inflation is better now than it was a year ago or 6 months ago. I don't think the Fed's helping us, but at the same time, the Fed is the system at the moment, so it's the game we all have to play. The if you look at indexes or indices online, sorry, the CNN Fear and Greed Index is actually a decent gauge on when to enter the market. Now, everything else on CNN, that's your choice. I don't watch CNN or anything mainstream for definitive reasons. But of when we want to get into the market, so you can buy it anytime, right? But when that meter ticks over to extreme greed, then prices are higher and yields are lower. When that ticker slips into fear and extreme fear, when everybody, so you've got the Fed hinting at lowering rates, you have this globalist, global economy, but also globalist take of things. So pumping fear based on Israel and Hamas, pumping fear on Ukraine, pumping fear that this little bitty Ukraine country controls a lot of their exploits and influences everybody else's food on demand. Think about that. And then you have all of these new investors trying to understand information that they just can't grasp yet. So you have new investors pouring money into the market just to pull all that money back out of the market. So they put in money when they could, they're pulling money out, they're losing money in the process, which makes them want to pull out money faster and faster. So you end up with this giant fear cycle or fear roller coaster, and we're on the downward slope of that. You have all this money coming out, share numbers are increasing, prices are falling, money's leaving the market in more than one way, right? And everything slides. And then everybody gets fearful, and that's the best time to buy. So, I mean, like, why is it the best time to buy? Easy, because everything's cheaper and the dividends are amazing. The closed-end fund dividend average as of 2 months ago was close to 8.4. As of today, it's closer to 9.5. So it's an amazing time to scoop a deal and an amazing time to get a great dividend off the deal. So where would I park my money if it's me, and it is me? I'm going to give you the specific tickers that I would stick my money in. So in general, and very contrary to popular advice, investing money in single stocks allows inflation to eat your gains. Apple is currently 10% less than it used to be like a year ago. Supposedly it's a great deal. But if it goes up 10% in the next 5 years, you've lost money based on inflation. Inflation's 4% a year. You have 10% gains. Apple pays a 0.5% dividend, right? So your 4% inflation notches down to 3.5 based on their 0.5% dividend. Your money is losing its value at a rate of 3.5% a year. So 3.5% times 5 years is what, 17.5%. You've gained 10% in 5 years. Oh, look, you've gained 10%. That's amazing. And your money is now worth 7.5% less. That doesn't help you. So if I still wanted to target Apple, I can find Apple in a closed-end fund. So I get greater access. I get less risk overall because of all the companies inside that portfolio. I get sector diversity, or I get diversity overall, or I get sector-specific diversity. I get gains over time. I get killer consistent dividends, and I get all of that on sale. I don't have to pay full price. I can pay full price, or I can pay over full price. That doesn't help. But I can get all of that on discount. And currently, there's a fund that's almost 50% off. That's crazy. So for every dollar invested, you're getting it for 50 cents. That's amazing. That's a Warren Buffett style deal that you're not going to hear about anywhere else in the media. So where would I park money? Pretty much in order. Let's see. I'm at a sticky note in addition to my notes on screen. So let's see. Real estate, oil, liquid natural gas, energy infrastructure, business development and bonds, tech, and then how that actually works out. Like what tickers would I pick? And I'm going to get to that when I show you the portfolio. So consumer used to be on the list, but it's not anymore. We're not honestly, we're looking to ditch the consumer side of our portfolio. I would go with like consumer infrastructure, but even then, if we're looking into consumer things, it's through a portfolio in a can. It's not a consumer-based or global-based consumer portfolio. And we have two of those, one by choice, one by accident. Um, Consumer cyclical stuff, it's listed as automotive, housing, entertainment, like hotel and restaurant, furniture and clothes. Supposedly the needs come and go, the prices come and go. But it shouldn't include real estate. Real estate's always in a category on its own. I mean, you can argue that parts of it are cyclical, but it's really not. Real estate is its own category. So if we're looking at anything consumer based, it's more like consumer infrastructure because the infrastructure of the consumer market is tech, oil, transportation, and steel. And at the heart of all of that is oil. It takes oil to move all that stuff around. It takes oil to process all of those goods. It takes oil to make technology, and it takes oil to blend steel together or to merge steel together. So yeah, we're looking to ditch the outright consumer part of our portfolio. So let's kind of get into that. Let me share my screen. So this is the closed-end fund master list. It says master membership because at some point I do hope to make a membership of this. Everything in gray does not meet the parameter. Light blue we own. Purple is recommended. Olive is interested. Orange, which there is no orange. Orange would be like a recently closed fund. Guidelines, we don't pay premium. And if you want to look at and just like an overview of closed-end funds, if for whatever reason you've seen my other videos and couldn't answer your questions or I didn't give enough information, this is a great place to start. And then these asterisks. So 3 asterisks is a buy alert. It's either double the historical or double the 5-year discount or both, or it's finally below premium. 2 is a dollar cost average alert based on our portfolio, and 1 is we're tracking for one reason or another. So there are 432 closed-end funds. The average yield across all funds is 9.4%, meaning some pay high, some pay low, some pay none, right? And the average in between. There is monthly and quarterly and like an alternate quarterly. Since category 1 would be 14710, 2 would be 25811, 3 is 36912. Plus, you also have some things that pay on like an off monthly cycle, like ASG. There's annual, semi-annual, the works. You really do get to pick your dividends. So how do we sort the list? Well, easiest way is we rate it by discount. We're not going to pay premium. So there's still a lot of stuff, right? Like there's still a huge section that's on sale. Well, I've already filtered it for my needs. So everything with a single asterisk we're tracking, even some of the stuff we own. Double asterisk for dollar cost. And this is what we're going to get into of further filtering. I like to have a current. It helps me figure out what to buy or how much we have. So when everything's a target, right, nothing's a target. So you still have to filter it. So they're filtered by discounts, right? If there were premium, which they're not, but if there were premiums, those would get eliminated. We could go by yield. My goal has been 9% or above. And I'll also say we don't plan on buying anything we don't already own. FEI, it gets heralded as a green energy company. There are people who like its funds. I bought it based on discount at a certain point, and of the oil funds we own, I'm honestly disappointed in the fund because it pays a consistent dividend. But since the return of the economy post COVID and post world lockdown, it hasn't changed the dividend. So it currently has a better yield, but at the same time, say if that goes back up to like what it was, not that great. Oop, wrong column. This number is dependent upon that number. So, oops, undo. So we're going to get rid of these things. So the Calamos funds I like. I mean, they're tempting, but they've got to be more tempting than what we currently own. And I need to dig into those portfolios more. Most of these funds are global, which means they get impacted a little more with all of these global events: Ukraine, Israel, Hamas, China, Taiwan, you name it. So we're not looking to add anything that what we don't already have. So how do we further filter the list? Well, it's based on those boundaries. It's based on those top companies of what we're looking for. So real estate, obviously. Bonds, these are preferred yields, which are great. So let me back up. So the other part of this is I know our portfolio. I mean, one, I look at it, I built it, but two, I know our portfolio. So we're targeting specific funds based upon current market environment and also based upon these discounts. We're also targeting funds based upon what we already own. So, meaning, this is what I mean by it helps me to know what we have. And I know this because I look at our portfolio a lot. That one I don't know offhand, but we're not going to keep it either. So the ultimate discount at the moment is this first one on the list. I mean, my goal has been to hit everything we're keeping long term at 200 or more, but that's based upon strategy and discount and the best deal at the time. So it's already at 200, but at the same time, that's an insane discount. Its sister group is at 100. And that's still an amazing discount. This is technology, portfolio in a can, business development, oil, portfolio in a can, preferred, technology, preferred, senior loan. It likes an aggressive Fed, so when the Fed stalls, it's kind of meh. Closed it, so they started their own closed-end fund portfolio collection within the closed-end fund. So it's senior loans, closed-end funds, and they still like what the Fed says. Real estate and bonds. So the quick rundown. So where would we go? All of these companies are amazing. All of them are great deals. Could you park your money in all of them? Yeah, it just depends on what you like. Outright bonds, like bonds run by the bond king, like the guy who does an amazing job predicting what the Fed's going to do, what the country as a whole will do. His fund does not go on this steep of a discount that often, and it's on a pretty steep discount, which I get it. 7% doesn't look like 47%, but it's still a really good deal. All of these pay above a 10% yield. Like, how do you pick? And, and I pick based on my portfolio, but I pick based on overall strategy. They're all great buys, right? They're all great buys. They all pay amazing dividends. You could do it by dividend policy. But it doesn't really help because these top two are on the list. That's technology, but it overall, that's at the bottom of my list right now. I like this NBXG fund, but it's not going to make the cut right now. The other thing, I like all of these funds, but knowing that order of things, knowing how, like what we want to focus on, helps eliminate these funds. So like BRW, love the fund, but not the focus. Let's see. Portfolio in a can. Currently like $2 under almost what we let's see. ZTR. That's our average cost. 671. Yeah, force it pretty much $2 under. An amazing buy. Preferreds. Yes, but not right now. So what the Fed is doing with inflation is really controlling the housing market. You could say it controls spending and it controls this, that, and the other. So let's see if I can frame this. So a year ago, even there was more housing movement than now. 2 years ago, there was a feeding frenzy. So you had lower rates, tons of homes on the market, but so you had not so much, you had supply, lower rates, and people able to afford. So it set off a buying frenzy. So prices rose. Well, then the Fed said, hey, let's raise rates. Well, not everybody can afford those houses anymore. So it creates more surplus on the housing market. Rates are higher. People don't buy as many homes. So inflation is devaluing your money. It's making it less effective. It's increasing the cost of things. It's also hitting you to where you can't buy as much as what you used to do. So if the Fed suddenly cuts rates, what do you think that's going to do to the housing market? Now, in the housing market is always building. Now, it might not be building in your neighborhood, it might not be building in your zip code, but the housing market's always building. It's always trying to catch up to demand. So when the Fed cuts rates, I think the Fed will cut rates as early as next year. So when the Fed cuts rates, we're going to see another feeding frenzy. Now, will it be the 2% rates or 3% rates we saw 3 years ago? Probably not, right? But as a hopeful real estate investor, if I'm having trouble paying both the down payment and making a cash flowing business with an 8% loan, that'll be more feasible at a 5% loan, but the house will have gone up in value. So if I could buy it now and reap the equity boost when rates drop, that's great. But if I can't, now I'm kind of stuck. And that's a lot of people. I want to move, I want to buy a house, but I can't. So they rent. And then you could argue the rent is higher than what it ought to be. Well, you've got a lot of people renting and not you have an increased demand of homes selling, but not selling. You have an increased demand of rental, but a smaller stock of rental. So at the heart of that, you have real estate, right? But you also have oil and energy infrastructure, and you also have small business development. So one of the guys I like is pounding the table on 3 or 4 specific individual business development companies. Well, that's great, but why look at all 4 of them when I can find them inside this one business development company closed-end fund? Um, Overall, you look at bonds and then technology, right? And then all of these become where to go. So where do you really put your money? I think we still have to prioritize. I mean, if you don't own a closed-end fund and you want an amazing place to start, we'll label this for the newbies. Right? If you want the amazing deal and the place to start at almost 50% off, that's an amazing deal. But for our portfolio, we already have 200. And I get that. I'm gonna, I'm considering that. So this would kind of make so real estate, oil, because oil moves the world. Oil controls technology. Oil impacts the building of anything. So yes, real estate, it's been hammered, it's down. Gosh, our portfolio, if I could buy equal shares of what we have, it's an insane dollar cost average buy for us. Excuse me. It's an insane dollar cost average buy for us, but it's also just a really good deal. Oil is a really good deal for us. It fits our portfolio, it fits our long-term goals. It's great. HFRO is a mixture of bonds and let's see, bonds. You're going to confuse portfolios. Bonds, technology, real estate investment trust. So it's a good mixture of all of those things, but it's actually just a good, it's a bond company, but it's a smaller subset of bond company, I guess, as opposed to this one who is just off the charts. So where would I go? And the specific tenders of where tickers of where I would go: IGR, KYN, HFRO, and if I had to pick a fourth, if I had to pick a fourth, I would pick the roller coaster. GLO and ZTR are roller coaster rides. You ride the coaster when it's low and you have fun when it's high. Currently, it's lower than it's ever been. Housing bubble, COVID, now. I think it's just based on the content of its overall portfolio. Okay, but you end up riding these waves, and the roller coaster ride is great until you face the next drop. But then you get to ride the wave higher. So let's see. Move this out of the way. To end up with IGR, KYN, HFRO, and then GLO. And it honestly, it's going to be dependent. So the strategy for us, we've got about maybe $450 sitting in Webull waiting to be spent. This fund we inherited. So it started with DDF. DDF loved their portfolio, loved the structure, loved the company plan, all the fun stuff. And they got bought out by Aberdeen. Now, we already had two Aberdeen funds. We've got this Aberdeen fund, which I'm not thrilled with. We have this Aberdeen fund, which I like, but I didn't want another Aberdeen fund. Um, and the more I look at it, I certainly didn't want this fund, but that's the fund I got. This number is inflated because when DDF disbanded and released the last distributions, they had an excess distribution. So that number is not entirely accurate. It's accurate, but at the same time, it's not accurate based on a full year of just AGD. So with measly gains, still not, I'm not bitter, just still irked, but with measly gains, and just, I'm not happy with this fund. And honestly, well, I'll get to that. Not happy with this fund. So would I like that to be higher? Yeah, but I'm at a point where I'm ready to just part ways. And I'm also at a point where I'm ready to part ways with this one. And just take the hit and recycle the money into something better. On that, this fund is a DRIP fund, a dividend reinvestment program fund. I wish the DRIPs were publicized because I looked at several websites before I bought all of these funds. None of them even so much as hinted that some of these funds were dividend reinvestment programs, meaning they pay a dividend, but you never see the cash, which I would like to reinvest my dividends how I would like to reinvest my dividends. So every time this company pays a dividend, they pay me a dividend and they take the money back and they auto buy more shares of the company for me. But I never see the dividend. And that's kind of frustrating. So in this decently built healthcare fund, I never actually see a dividend. Like I get it, but it's not like I could hold it in my hand. So one, that doesn't meet our strategy. Two, I saw a missive saying they had considered having Aberdeen now advise them on the overall fund, which I don't like Aberdeen. And this fund not meeting my needs much anymore. And now I find out they're going to involve Aberdeen and how they manage the fund. And to me, Aberdeen's, yes, it's a well-known name, this, that, and the other, but their portfolios doesn't really change. Like it goes up and down, but like if that's the line, the average line, it equally goes up and down. It never just goes up. So on my end of things, I like the fact portfolio. I like the Pacific Rim portfolio, but this consumer-based things, yeah, not a fan of. So I'm I'm looking to sell the two consumer-sided Aberdeen funds. Also looking to sell this, but I'll probably won't sell that until they pay out the final dividend of the year. And I'm also looking to sell this, but of all, say between USA and HQL, USA is another dividend reinvestment program. This one has promised to go up, but I don't want to hold it long term because, and it's marked as long term. It's actually marked as lifetime because of the amazing dividend. But I never see the dividend. And that's not a strategic advantage to me. And that, so if, let's see, that's fine. I'd rather mess this one up than mess up my spreadsheet. So current environment, if you bought 100 shares of USA, you would get a period in, like a quarterly dividend of $16. So let's say it's more. Well, that's $160, right? $640 on the year. That money touches your account and goes straight out and just buys more shares. That's great whenever you sell the fund, but that's not actual money in your pocket. I could do a lot with $160 now. Like, let's use it on IGR. buy a decent amount of shares of IGR right now. Let's see, 16 cents a share sounds like a lot, but if I compare that to IGR pays 6 cents a share plus the second month plus the third month, and I can get a better monthly production of investment through a different fund than I can of this one. Now, if you want, blue chip USA backed companies, there are plenty of other companies who do that, and they pay monthly, and they pay better. Now, USA has an amazing track record. Their stock price almost always goes up. Their dividend has been up and down, but I wish I knew who. I wish the dividend reinvestment programs were outright marked, because for me, that would be a clear steer off. Like, hey, that's a really cool fund, but I never actually get paid the money. I get paid the money, and then it leaves. It never stays to where I can reinvest it somewhere else. Drip programs sound great if you have no idea what you're doing. Like, oh, you reinvest the money for me? Wonderful. I don't have to do anything. But that's not my style. Like I built all of this stuff because I want to run it and manage it. I don't want somebody else to do it for me. And that's kind of gets into what I want to do membership wise. Membership wise, I want to offer the service, the same thing. Like here's the stuff that I built. Here's the access to my so here's the full closed-end fund list. Here's the access to our past portfolios. Here's the videos, or say the data for the videos for the last several weeks. But at the same time, I'm not investing your money. I would run like a paid for membership service, but at the same time, you're investing your money. You're investing your money in whatever stock market platform you want, and you're doing your own brokerage services. This is a completely self-managed portfolio. So I want to teach and educate and give insight and give input and rationalize and be able to logically walk you through something and say, this is what I'm going to buy. And on the back end, you can look back and be like, well, heck, he said he would buy that. And hey, look, on this date, he bought that, and that's how much he bought. Like I want full transparency of this is what we bought and here's how we're doing. So if you come down to the bottom, these are the more important numbers. I mean, I track that just because total investment, our annual projected dividend, which is that rate, our current accumulated dividends. We started in March of 2021, and that's what we've generated so far, which is that amazing level of return in the last 2.5 years. Yeah, I mean, I saw a meme today that was like, invest 20 grand and get $600 a month, or excuse me, invest 20 grand and get $600 a year. That's a horrible investment. Like, that's a horrible investment. And that's a 3% return. You're losing a percent of your money every single year to inflation, and it's never growing. That's a horrible return. And yet that's what's getting touted as amazing on these financial advisor pages. Like, that's crazy to me. But at this, even if inflation is 4%, then we're still making almost 6% a year. Right. And as we invest more at this rate, yes, then our dividends will grow. And if you want to see how that breaks down, it's inside the spreadsheet. So you can look at what we started with. So first year, second year, part of this year, and there's the total. My goal is, I mean, yes, it's a paid for service. Do I want to get paid for this? Yes. but I want you to invest your money and I want you to manage your money and I want you to take on the responsibility of doing your investing because it's far easier than all those Tom, Dick, and Harrys would love to have you believe because the more you think it's complicated, the more they have a job and the more it's their strategy and not your strategy. And the more it's that shitty 4% rule and the old like 60-40 stock to bond ratio that just does not cut in this market. Uh, Old strategies for a new market just helps nobody. It helps your broker, it doesn't help you. So I would much rather teach and help you learn how to do it and give you access to what I'm doing for our own investments. Like I do all of this on my own for our own investments, for our self-managed portfolio. Why wouldn't you want to use what's already built? You can cherry pick. Gosh, you could cherry pick my own portfolio. So yeah, I mean, why not? So will there be a membership at some point? Yes. If you want a membership, email me and ask. Fire away. Um, if you think you know, yeah, I'll put it to y'all. If you think you know how I can make a membership out of this, then by all means, send me a comment and let's talk. So that's all I got. I'll be talking in circles for forever. So those are my top selections: IGR, KYN, HFRO, and if I had to pick another one, GLO. If you like the content, consider subscribing to the channel, hit the like button, and then head over to Facebook and join my group there called Navigate Your Finances. The link will be, or the information will be below. YouTube's kind of frowned upon posting external links in the descriptions now. So as you face the week, as you face your strategy for long-term growth, as you face your strategy for retirement, you are the captain of your ship. Your ship will go wherever you steer it. So if you want to spin in circles or go backward or just hope to float in the water and never really go anywhere, it will go where you steer it. So make sure you steer it in the direction you want it to go because you do have the power to change your life and your financial future. All of these people are going to offer to help you, which I get this video is just like all the others. But, or maybe hopefully it's not like all the others, but I get it that it's just another video, right? And there's lots of other videos online. And many people, I mean, I talk about them every week when I do financial memes. Many people will offer to help you, but you have to get really good at filtering out the good stuff from the bad stuff so you can make the best choice on who to listen to, but also the best choice of who to include in your circle. Okay, you have an immense power to change your life. There are a ton of people who are going to offer to help you, but you have to be the one to do it. You get to make the choices. You get to follow through with that. You bear the responsibility of that. Make sure you know what you're doing. Make sure you know where you want to go. And if you have no idea how to get there, if you have no idea what you want to do, then let's talk. Find me on Facebook and let's talk about how you can learn to navigate your finances. Whether that's navigate your finances to investing in the market or real estate or starting a company or any number of things. But if you want help navigating your finances and if you want to learn from somebody who's doing the same thing, then find me on Facebook. So whatever you have, whatever you're doing, you're going to have to make it happen because it's not going to happen on its own. Whatever dream you want to achieve, whatever hope you have for beyond this moment in your life is not going to happen on its own. Because if it could happen on its own, it would have already happened on its own, but it's not. So you have to make it happen. And as you do, as you go along, as you gain progress, as you get better at what you're doing, and you really do start to make progress toward that goal, people will start to ask, hey, what's different? hey, something changed. Tell me what's wrong. Or tell me what's different. Tell me how it is you're doing these things, right? So make some progress, shock your people. Make some progress, shock your circle. Or what I say, shock your world. So make your dreams a reality. Make it happen. Shock your world and help somebody else do the same thing. So this is Daniel Young signing off. I will see y'all on another video. Bye-bye.